Welcome back. Let's continue with part 2 of financial institutions and money creation. We've just seen one example within one bank of the creation of money and the resulting decrease in the reserve ratio. Let's see how this process works in the aggregate or total banking system. When one bank makes a loan, there's money in a customer's hands, and that customer pays someone, and that someone eventually will put money into maybe the same bank, maybe another bank. So cash is moving around from one bank to another. A loan from one bank ends up going into another bank as a new deposit. When cash comes out of a bank, deposits don't change. The asset composition changes, but there's no change in the liability side of the balance sheet, no change in deposits. However, when cash comes into a bank, a new deposit, that's by definition an increase in deposits. So cash out does not change deposits, cash in does. So in aggregate banking, the concept of money creation works as follows. Banks are making loans. Whenever a bank makes a loan, the reserves decrease, and when those funds are deposited into another bank, that bank's reserves increase. So one bank's decrease in reserves eventually is an increase in another bank's reserves. There's no change in deposits at one bank. The withdrawal from one bank doesn't affect deposits. When those funds are deposited into another bank, there is an increase in deposits at that bank. There are no change in reserves in an aggregate sense. One bank's reserves go down, another bank's reserves go up, and in the aggregate, there is an increase in deposits because the withdrawal of the loan from one bank doesn't change that bank's deposits. When those funds are deposited into another bank, that other bank's deposits do increase. So the aggregate effect of this activity is no change in reserves, an increase in deposits, and the result is a decrease in the aggregate, in the overall reserve ratio. And again, a lower reserve ratio equates to higher risk. So let's look at an aggregate money creation example. This is going to be a few slides. In step 1, Bank A makes a loan, and we've already seen this same transaction a few slides back in part 1. Bank A makes a $30 loan, so notes and coin go down by $30, getting to a new balance of $20. Loans go up by $30, a new loan balance of $890. No change in total assets, simply a change in composition. And looking at the bottom of this calculation, reserves have gone down by $30, deposits have not changed, and the reserve ratio as a result decreases to 11.1%. Again, we've already seen this scenario looking at the individual bank example. Now we're going to expand to the aggregate banking system. Where does this $30 go? This $30 goes into Bank B, and what they eventually do with that $30 is they make a new loan. So let's see what's happening at Bank B. And to simplify the example, the initial balance sheet of Bank B is the same as the initial balance sheet of Bank A. So what did Bank B do with the deposits that they receive? They do what banks typically do, which is lend money. So we will see the combined activity of the new deposit followed by the new loan in the new Bank B balance sheet. Starting with notes and coin of 50, we have the same final notes and coin. We had an increase of 30, and then a decrease of 30. Deposits came in, loans went out, so notes and coin, the net balance is as it was, $50. Loans has gone from $860 to $890 because we have a new loan of 30, which is an increase from $860. We're adding $30 to what we had to get to a new balance of $890. Notice that deposits is also increasing. Deposits has gone up by $30. From $720 to $750. And so what is changing in Bank B that didn't change in Bank A is total assets and liabilities. We have total assets increasing from $970 to $1,000, and liabilities and equity has increased, also, of course, matching to $1,000. Now, our reserves and our deposits. Let's see what we have. Reserves are, again, at $110. There was an increase with deposits of $30, a decrease with the outflow of a new loan of $30. The net change is no change, from $110 to $110. Deposits has increased from $720 to $750, and as a result of no change in reserves but an increase in deposits, we have an increase in the a decrease in the reserve ratio from 15.3% to 14.7%. So this is the activity at Bank B. Now let's complete the aggregate analysis, and let's assume that the new loan of $30 ends up going to another bank, and that bank is going to be the bank we initially looked at, which is Bank A. So step 3, recipient deposits the $30 to Bank A, and then we will stop here. This could continue on. Instead of depositing this $30 to Bank A and stopping, Bank A could make a new loan. Or, instead of this $30 deposit going to Bank A, it could go to Bank C, and then Bank C would make a new loan. Perhaps that money would end up in Bank D, etc. Regardless of how many banks are involved, the aggregate effect is the same in the banking system. So let's see what happens when we end our analysis with this deposit. Bank A notes and coin had gone down. Originally it was 50. It had gone down to 20. And now with the additional 30, increasing notes and coin by 30, we have a notes and coin balance of $50. Loans isn't changing because there's no loan being made. When we go to deposits, deposits was $720. With this additional deposit of 30, we add 30 to deposits to get to a new amount of $750. And notice total assets has increased to $1,000. Total liabilities and equity also has increased to $1,000. And let's look at the situation of reserves and deposits to calculate our new reserve ratio. Reserves has gone up by 30 as a result of the new deposit to equal 110. Deposits is also up by 30, a new amount of 750, and the resulting new reserve ratio is 14.7%, which is an increase from our reserve ratio of 11.1%. So Bank A's initial position was a reserve ratio that decreased when they made a loan, and now it's increased with this new deposit. So let's look at the aggregate. Let's look at the final result. What's the result in the aggregate banking system? The result in summary is that Bank A and Bank B both have an increase in deposits from $720 to $750. The same in both cases, from $720 to $750. So in the system, total deposits, and therefore because deposits are a component of money, we define money as deposits plus any cash outside of the bank. So when deposits go up, money goes up. Money has increased by $60. And let's look at what's changing in the reserve ratio. Stepping back for a moment, an increase in money is good. Banks are encouraged to lend because when they lend, they receive interest income. The result of lending, we have just seen, is an increase in money. The scenario in which Bank A made a loan and Bank B made a loan has increased money by $60. That's good for banks. It results in increased interest. Increased lending results in increased interest, and increased lending results in an increase in money. So what's the downside? The downside we're going to see in the change in the reserve ratio. The aggregate reserve ratio, when we look at Bank A and Bank B combined, the aggregate reserve ratio was 15.3%. Now, of course, when they both were 15.3, the aggregate is going to be 15.3. If banks A and B had different beginning reserve ratios, then we would calculate an aggregate reserve ratio using a weighted average type of calculation as we saw in part 1 of this session. Let's look at the ending reserve ratios. Both banks have an ending reserve ratio of 14.7, resulting in an aggregate banking system reserve ratio of 14.7. And that, notice, is a decrease. We went down from 15.3 to 14.7%. We have a decrease in the aggregate reserve ratio of 0.6%. In summary of this three-part activity between Bank A and Bank B, loans and deposits, the cost of a money increase is a lower reserve ratio, and as we've seen, a lower reserve ratio means higher risk. So, keeping in mind that the banks want to increase loans because that results in increased interest income. Increased loans have two results: an increase in money and a decrease in the reserve ratio. That final result, the decrease in the reserve ratio, means increased risk. So the banks are incentivized to do something that benefits the banks and increases risk in the banking system. And as that risk increases, we get to a situation in which we could potentially have a banking implosion. Risk can only go so high until there's a serious negative result. And governments, and of course the people in a country as well, don't want to see that happen. The government usually has to step in to prevent the banking system from overheating. So let's take another look at the central bank. Let's talk about money supply controls to conclude this session. The central bank will put some controls in place to prevent the banking system from overheating and eventually imploding. Those controls are interest rates and reserve ratio requirement. The central bank, remember, lends to commercial banks, and when central bank interest rates increase, the cost to commercial banks increases, and they pass that cost on in the form of higher interest rates to their customers. So the central bank interest rate has an effect on commercial bank interest rates, and that has an effect on the attractiveness of loans. So when a central bank decreases rates, that encourages more lending, and that encourages or produces a money supply increase. As we've seen, when lending goes up, or when lending happens, the money supply increases. And when a central bank wants to slow things down, they will increase the central bank interest rate. That results in less lending because rates are going up at the commercial banks, making loans less attractive, which produces a money supply decrease. So what is important about the money supply increase or decrease is the effect on the reserve ratio and the related risk in the market. So when the money supply goes up, there is a higher level of risk because the reserve ratio is going down. When the money supply goes down, there is a lower risk level because the reserve ratio goes up. So the interest rate that the central bank sets, it has an indirect effect, eventual effect on the money supply and the reserve ratio that is in the aggregate banking system. The central bank can also directly affect the reserve ratio. They can set a reserve ratio requirement. The banks can't go under. The lower the ratio that the central bank sets, the more lending activity there will be. And again, when there's lending, there's an increase in the money supply. The higher the reserve ratio set by the central bank, the lower the level of lending in the banking system, and the lower the level of money supply. So we saw that in the aggregate banking system, loans result in deposits, result in loans, result in deposits, etc. The result of the lending activity is an increase in money and a decrease in the reserve ratio, and that means a higher risk situation. So when a government wants to control the risk in the banking system, they can use these two policies: the central bank interest rate and the central bank reserve ratio requirement, to manage the risk in the aggregate banking system. This concludes our lecture on financial institutions and money creation. Be sure to work through the exercises that accompany this lecture, and I look forward to seeing you in class for our case study analysis.